First up, we're going to hear about streaming in a session called Alternative Sources of Capital Meet the Streamer. We're delighted to welcome from Flowstream Commodities, all the way over from Europe for this event. We have their Chief Executive Officer, Jan Laubjerg. I've messed that up completely. But anyway, he will tell you how to pronounce his name properly. Jan, over to you, please.
Thanks, Leo. It's Laubjerg, but don't worry about that. So I had a little bit of a problem with the title of this session because we like to think of ourselves as not being alternative finance, but actually very mainstream. But I'll leave it to yourselves to judge at the end of the presentation. So what is Flowstream and what do we do? We are a corporate that basically, can you hear me? We're a corporate that basically does two things. We provide capital to the oil and gas sector through a slightly different form of funding than you may have seen day to day. The way we do it is we provide capital up front and we take what is effectively a royalty-like exposure to a specific asset or set of assets. And I'll come to describe that in a bit more detail. Now, the fact of the matter is, if we provide capital to get royalty-like exposure, wouldn't it also make sense for us to actually buy royalties? So that's the second thing we do. We buy existing royalties in the oil and gas sector. We have two primary shareholders. As I said, we're a corporate, not a fund. Those two shareholders are KKR, who I think are well known to most folks, and secondly, an entity called Global Gate Capital, which is effectively it's a private equity fund as well, but it's effectively Qatar. Where have we transacted to date? We've transacted in Europe, we've transacted in Asia. We'd love to do more in both. We have a global mandate. We have done deals which we think are fairly representative of what we also want to do going forward. So deal sizes have varied from double-digit $1 million up to, in the case of the Cairn deal, a $200 million deal. Spread over two assets in the case of Cairn, and in the case of Premier, it was $100 million on a single asset. I should say that there's an obvious reason why we're in Asia Pacific at a conference like this. We have a particular interest to put more money to work in this part of the world. So let me elaborate a little bit more on what a stream actually is. I want to stress we are not a trader, so we don't deal with physical commodities. We don't look to compete with physical commodities. All we're trying to do is be a liquidity provider, a capital provider, in return for taking production risk, taking commodity price risk, taking development risk, but not actually taking equity in the underlying field. Now, the way to do that is basically a royalty. So what we do is we provide capital and get a contractual royalty-like exposure to an underlying field or set of fields. And I'll later on in the presentation talk you through the Cairn example being the most recent example in a little bit more detail. Now, some of you may be, the other thing I would just really stress again, we don't take physical barrels. So please don't think of us as being in competition with the Vitols and Glencores of the world. Quite the opposite. We actually have a very symbiotic relationship with the trading community. You'll see on our website we have a formal agreement, for example, with BP Trading, and it just makes a lot of sense that if they're looking to secure your offtake or a producer's offtake, and the producer's looking for capital in return for that, why not let us provide that capital? So some of you might be thinking, this sounds very different. This is something we haven't seen before. Is this some form of alchemy? I don't want to be the guy who goes first here. The reality is that in North America, this is an extremely well-developed funding form, particularly in the mining space. And really, all we're doing is two things. One, exporting it from North America, and secondly, moving it into the oil and gas space, which we think is deeply underserved in terms of forms of capital provision. So the names you see on the screen up here are really very large listed entities that do what we do. They just happen to do it primarily in the mining space. So I don't mind putting their names up because you won't get much traction if you call most of these guys trying to have a competition between ourselves and them. But I hope you can sense that this is a well-trodden funding form. I've already commented on the fact that what differentiates us critically from debt, and that's why we always hate the word, us lending to people, because we don't, is that we're assuming most of the equity risks. Yes, we don't sit on the license, and therefore we don't have to fund cash calls subsequent to our initial deal, but we do take a number of very traditional equity-like risks, like commodity price movement and production overperformance and underperformance. When do we get involved with the underlying fields? Well, again, if we're prepared to take more of the equity-like risks, then by definition we should also be willing to come onto the field before traditional senior debt is available. And so what folks will find is that most of the deals we've done have been on development assets, and we have a team that takes a view, just like an oil company will, on what's the development timetable, what's the production profile likely to be, and then we basically take that risk once we've signed the deal. A sort of laundry list of differences between what we seek to deliver versus what versus other traditional funding forms. Let me try to simplify this. End of the day, what is the definition of debt? The definition of debt is ultimately you have to pay back, irrespective of the performance of your underlying asset, right? And effectively, the definition of equity is it's perpetual, but you also have some form of governance, some form of influence and control. We have neither of those two dynamics. So if you're an oil company, what you're getting is you're shifting those risks onto us, the equity risks, as I've said multiple times, but you're not giving up governance because we don't sit on your license. Therefore, we don't dilute your bookable barrels. We don't have a say in your JOA. We don't have a say in the technical committee. And that is part of what we think makes us more attractive to oil companies than issuing equity. Ultimately, though, I can say as much as I want to about governance and risk. Ultimately, what every corporate probably cares the most about is cost, and I'll come to that. How are we priced? Every situation is slightly different, therefore it's inappropriate to put an actual set of numbers on the y-axis here. But you can think about it like this. We're taking a lot more risks than debt, so we should be a little bit more expensive than debt. We often also sit behind debt in the cash waterfall, and often sit behind debt in a security structure. On the other hand, if we weren't cheaper than the oil company's equity, what's the point of us, right? The oil company could just go out and issue equity. And so, as a rule of thumb, but I'd like to stress this is just a rule of thumb, is people should think of streams as being priced in, call it the mid-teens, sort of rate of return, on the expectation of a 2P production profile, on the expectation of the forward curve, right? That we think is a fair balance on risk and reward. As I sometimes point out to oil companies, we could end up being a lot cheaper than the debt. If things go wrong, if oil prices collapse, the implicit cost of capital that we represent drops, whereas the debt's cost of capital stays the same because you still got to pay your coupons. So that is the sort of sharing of risk and reward quantified. A lot of detail here, but basically on the Cairn deal, the highlights I'd like to just flag for you is every deal we do ultimately ends up being very structured to fit the actual dynamics of the underlying field and the actual objectives that the oil company has. I'll come to it in a moment, but you'll see that this specific deal was highly tailored to reflect those two factors. The other thing is we're not in the business of funding distressed companies. So I think it's generally acknowledged that Cairn Energy is a very successful oil and gas company. It has a relatively clean balance sheet and a relatively strong funding position as the oil sector goes. And so some might say, well, why are you transacting with them, or rather, why are they transacting with us? I want to stress that for us, what's important is we need to feel we are complementary to an existing capital structure of a successful company because we have no governance rights. And so we're taking the ultimate bet on management. And that's one of the reasons why companies that are doing well and generally are not in distress are generally our preference. That's not to say we can't help with deleveraging. And obviously over the last 2 years, a lot of the discussions we've been involved in and a lot of the deals we've looked at have involved a degree of deleveraging. I think the other thing I'd like to say is it's very important for us that the deal is well received by the other stakeholders of the oil company. So the reason we put this chart together on the top right-hand side of this page is because we are always laser focused on when we announce the deal, what happens to the share price of the oil company. And so in Cairn's situation, their share price went up. If I showed you the same chart for Premier, you would also see it went up quite significantly, in fact, more so than with Cairn. I'm just going to make one point on this page, again, on the Cairn case study. Please don't think of us as trying to compete with senior secured RBL-style debt. That's not what we're trying to do. We're trying to complement that funding form. In actual fact, if an oil company cannot get a senior secured form of debt, be it an RBL or otherwise, at some point in the life cycle of the asset, then it would worry us. Why is it that the banks think this is an asset that shouldn't be funded? What we're trying to displace is the oil company's equity. As I said earlier, we look to be cheaper than the equity, displace the equity such that the equity gets higher returns and is preserved. And so the point we like to make with this slide is that the major banks out there, major lending banks, have embraced us. We are in the same capital structure as them. It's public information. We're second lien, which meant that all of these first lien banks had to approve us coming into the capital structure. We have an intercreditor arrangement, et cetera, et cetera, et cetera. So we look to work very, very closely with the banking community, not compete with it. And finally, on the Cairn structure, I said I would describe how it was structured to give you a sense of how tailored these deals can be. In this deal, the underlying asset, the Kraken oil field, we felt that it was important for us to get our money off the table fairly quickly. And also, the producer, I think, felt that they wanted to constrain our upside if oil prices rose materially. So rather than just taking a flat percentage, which would be a typical royalty, what we did was we constructed it such that we took a large percentage, in this case 100% of 4.5% working interest, until we hit a 10% IRR. Then it steps down and we take a 30% share of the 4.5% share until we hit a 15% IRR. Then we step down to a 15% take of the 4.5% for the life of the field. And that means in an upside environment, they hand over less capital to us, so we don't have completely ungeared upside. But on the other hand, we also get our money off the table a little bit faster, and that was the quid pro quo for getting our money off the table a little bit faster. So just to conclude, we, as I said, are focused on global opportunity set. We spend our life on planes. We have particular interest to put dollars to work in the Asia-Pacific region. We take development risk. In fact, most of the deals we've done have been development assets. We have a strong preference for long-dated assets, which is one of the reasons we're so focused on Asia-Pacific. And the use of proceeds can frankly be anything. If it's a development asset, we need to know the asset is funded. If it is funded, beyond that, we frankly don't care what the oil company seeks to do with the capital. So they can delever, they can dividend it out. We're quite flexible in that sense. Finally, I'm around for the next day and a half, so if anyone wants to continue the discussion after our fireside chat as well, then please do give me a shout. Thank you.
Take a seat, and we'll have a few questions. So, thank you very much for that presentation. It's very informative. We've obviously seen from those of us who have attended some of our mining events, we've sort of heard from streamers in the past. But why in this stage in the cycle, and this sort of possibly bottom of the market on the way up, why do you think streaming works so well? Is this a good opportunity for you? In the mining sector, the streaming companies tended to flourish at the bottom of the market. Is it the same in oil and gas?
Yeah, can you hear me? We like to think that our funding form is a cross-cycle funding form. Capital is always needed in the oil sector. There's just a difference what the primary focus of what that capital is used for. So obviously in 2015, 2016, a lot of what we looked at was folks who were looking to manage covenant ratios, who were just trying to delever and didn't want to have to issue equity to do that. What we are seeing slowly shift as oil prices recover, which was also the case before 2014, is really that our capital becomes much more relevant for development purposes. People are back putting money into the ground to do deals rather than fixed balance sheets. And secondly, for M&A. And so we tend to try to think that we have a relevance right the way through. It's just what the use is that changes.
So I guess at the bottom of the cycle, you're saying that companies can use you to kind of deleverage, as you say, because the stream doesn't get counted as debt.
Correct. So I don't mind saying, because people can, if they spent a good amount of time, can ascertain from public information that the deal we did with Premier Oil closed 2 days before their covenant tests. That's perhaps not a coincidence. Because their key covenant, and again, all of this is public information, their key covenant was net debt to EBITDAX. The way our deal gets accounted for, it's cash, so it helps their net debt, and it gets treated the other entry on the balance sheet is deferred revenue, which is a non-financial liability. So it's only beneficial to their net debt to EBITDAX ratios. So yes, during the downturn, that was a strong focus.
And I guess there's a lot of companies who, at the peak of a cycle, might have invested heavily in a new project, racked up a lot of bank debt. Oil prices then fall; they find themselves in a slightly awkward situation, and you guys can come along and it's already a good project. It's already been de-risked. Great opportunity to take advantage of that situation.
Yes, but I really do want to make sure I don't create the impression that we're there to help people when they've got balance sheet troubles. As I said, we'd like to think we live across the commodity cycle, but also one of the things I want to stress here is that if you take Cairn as a very good example, if you step back and think about what benefit they actually got out of it, because they didn't need liquidity per se, but they have two parts of their business, and this is my view, not necessarily something they have said to me. They have two parts of their business. One part of their business, well understood, is Senegal, has lots of further value on the upside. The other side of their business is a more mature North Sea business, which in the public markets was not getting that high a valuation. And anyway, that part of the business strategically was always meant to provide cash for the bit that the public market likes much more, the Senegal part. So why not just accelerate the monetization of those future cash flows in the boring part, being Kraken and Catcher, which is what we did the deal with them on, in the North Sea, and have the ability to rotate that capital into Senegal, such that as long as they're getting a higher rate of return over in Senegal compared to the cost of capital on their deal with us, they've made more money for their shareholders, and they've just accelerated on their strategy. So we are really not only there to fix broken balance sheets.
Fair enough. But as the market improves and more equity capital becomes available, how do you think companies will view you? How easy will it be for you, do you think, to source new stream deals?
So frankly, our biggest frustration over the last 2 years has been that there's not enough equity globally for the oil and gas sector. I thought it was both humorous but also quite interesting when a gentleman earlier today said that the Canadian retail investors are most interested in cryptocurrency and marijuana. I don't know if that's really the full impact that's or the primary driver of why there hasn't been equity for the oil and gas sector. But the issue is, because we don't have a governance role, we need to have equity, real equity, by the producer in the project. So whilst there has been senior debt, not much, but some, without equity, the capital structure doesn't happen or doesn't work for us. And so a number of deals we've looked at over the last 2 years have just been held up because the promoter, the oil company, couldn't find the equity. So we're looking forward to folks being able to raise equity again, because we think a whole bunch of opportunities that have been locked and stuck will hopefully become unlocked.
Absolutely, and I guess your model means that your goals and the goals of the company you're investing in are highly aligned, because obviously if they don't go into production and they're not producing the barrels that they should be producing, then you're not getting your returns.
As I always say, what we like to do is cut the check, and then we'll stand on the sideline and be their biggest cheerleader.
Absolutely. Quick question for you though. Given that the length of your investment in the company can be is it 5 years or something like that, and then, but how are you making price assumptions about where the price of oil is going to be in 5 years' time, given the kind of volatility in the market?
Yeah, I mean, your question is a critical one, and I would like to stress, if we're in the asset for only 5 years, we are generally not very happy. We much prefer long dated exposure, which is why there's some very interesting, very long dated opportunities in Asia Pacific, whereas in the UK North Sea, I'm sure we'll hear more about this tomorrow morning, the opportunity to get 20-year exposure is very difficult to find. So of course that accentuates the importance of what you ask. How do we get to a view? Look, how does an oil company get to a view? We take a view. And as a boardroom, we say, look, this is what we're prepared to invest in. I said up on the podium that a good reference point for folks is to say, hey, gee whiz, Flowstream's probably going to look for mid-teens if I'm plugging in a 2P production profile and the forward curve. Now, do we invest solely on the forward curve in the boardroom? No, we look at lots of sensitivities, and actually, we don't have, people find this hard to believe, we do not have a price deck. So it's a judgment that's taken on each deal situation. Now, I will also admit that we tend to very quickly turn around and call Ian and his colleagues and say, how much of this can we hedge out? We are unashamed users of the financial markets for purposes of hedging out commodity price risk.
And I guess also you're looking for projects which are profitable at a pretty much any oil price.
Yes, if we could find that, I'd be delighted. But no, absolutely. Joking aside, the technical diligence, probably single most focused area, is where's this thing break even, and where does it break even? Not just now, but 5 years out, 10 years out.
So, how did you get into streaming in the first place? What attracted you to the sector?
There was a very clear market need. The number of funding forms available to the oil and gas sector are outside North America are shockingly limited. As a former investment banker to the oil sector, that was abundantly apparent to myself and my co-founder. And so when we practically stumbled over the streaming business model, we just thought this is a no-brainer that we need to help capital access the sector internationally through this structure.
And will you be? Is it listed company? Yeah.
We are a private company, and who knows? Obviously, given who our shareholders are, it is fair to assume that at some point they will be looking for a liquidity event. Who knows how that will be achieved?
It's like Franco-Nevada and Silver Wheaton, people like that. Some of the mining streamers you mentioned have had amazing success listing and have achieved very high valuations.
I like to remind my board of that.
Do we have any questions for Jan from the audience? Anybody out there got a
Don't be shy.
burning question? No? Well, if you want to grab Jan later, please do, because I know some of this, it gets quite complicated, and it maybe you'll have a question which you don't want to sort of share in public. But Jan, going forward, how much dry powder do you have? I mean, what's your next move, but how big can it get for you from here?
So, well, a couple of observations. First of all, we are still very much in the capital deployment mode. We've got a number of deals on the boil, and typically we focus on deals in the sort of $75 to $300 million range. For interesting, unique deals or strategic deals, we'll go smaller. So we're currently working on something that's sort of in the $30-40 million range. And look, we have one other benefit, which is a little bit different from other, can I call it, portfolio companies of private equity firms, because we're not invested in out of the private equity, the traditional private equity funds, but we are invested out of other pools of capital that these GPs manage. We continuously aggregate further assets. So actually last year, we did the Cairn deal, but actually we ended net up on capital because we raised more capital than we invested. So we will continue doing that as long as we can, and then eventually I'm sure there will be a liquidity event.
And I guess some of your LPs there, they've got some fairly deep pockets, yeah, the Qataris.
Yes, I mean, right now, the issue is not capital. The issue is finding opportunities with the right break-evens, the right management teams, right duration, and then right terms.
How many projects do you typically look at before you invest in something?
We are quite similar to a private equity firm in that sense. So if that gives you a sense of hit rates, it's a little bit distorted to give you actual numbers because we actually see a ton. But as I think some folks in the audience will know, we are also very quick to say thanks but no thanks. So that's how we approach it.
And typically, how do you source your investments?
Shoe leather, relationships. The reality is that in the team there is combined many decades of oil and gas related experience, and everyone, no matter what their role is, they also are responsible for origination.
Coming to conferences, I should think.
That's part of it.
Well, hopefully, going forward, as we build this event and our event in London, we'll be able to, have lots of companies for you to look at in future years. So we've run out of time, unfortunately, there, but that was a very interesting insight into the streaming model. So thank you very much, Jan. Round of applause, please.
Thank you.